Well, again, good morning, everyone, and welcome to the weekly life insurance webinar sponsored by Messer Financial. Here again today to hopefully be able to provide you with additional information, showing you some sweet spots and some things you can take back out into the business world so that you as agents can speak with confidence and basically sell more life insurance. First of all, a little housekeeping again as always. Your phones have been muted, but occasionally something may slip through. So if you hear any background noise that might sound like it's coming from right where you are, please go ahead and mute your phone personally. We're going to ask again, as always, that you type your questions in to the box on the side for questions. And after the presentation is complete, we'll go ahead and review those questions. And again, as always, stay with us until the end so that we can not only review the questions, but so that you as agents that took the time today to be with us will be the ones able to collect a bonus if a sale is produced based on today's information. So with that in mind, my opportunity again today to turn over the presentation to Steve Summer. Steve is with the MinnesotaLife Group. He has been on with us before, done a very exciting presentation, and that will also be a presentation for agents in the future when you choose to attend our expo in September. You're going to get a recap of that one as well. So again, Steve, good morning.
Good morning. And thank you for having us. What I'm going to discuss today is one of our turnkey marketing programs that our advanced market team has put together. One of the things that MinnesotaLife does, I think, better than most other companies is actually put together turnkey programs that are complete with advisor training materials as well as client-approved support materials that you can use. Lift being one of them. Life insurance is a financial tool. Can basically walk you as well as your clients through how they can use life insurance as part of their overall financial plan, not just for death benefit purposes. We also have another one called Bold Business Owner Life Stage Design, which is designed, again, turnkey program that you'd be able to have access through Messer. And that's designed to help you market to small business owners. And then we have Epic, which is estate planning individually centered. Again, another turnkey program complete with advisor training and materials that you can use that are client approved. And you can get all three of these programs through Messer by contacting their sales desk, and they would be able to get that information to you. But today we're going to talk about Lift, life insurance as a financial tool. Here's the disclaimer. There will be a quiz later, so be sure you memorize that. And then we get into Lift. Now, what Lift, again, Lift being one of our turnkey programs, it really helps provide your clients with a way to provide lifetime protection for their loved ones, to maximize their retirement income, and to reduce taxable income in retirement and maximize their estate that they're planning on leaving or would like to leave to their family. The four major concerns that most people have entering into retirement or in retirement is ensuring that the family's future is protected in their absence, protecting the value of their assets, retiring comfortably, and efficiently passing the value of the estate to the family. And that would be tax efficient as possible. And the clients that you work with most likely already have accumulated assets to help address these concerns. These assets are basically the financial tools that they have, and they can be sorted in three basic categories. You have your capital assets, assets with a tax basis, which would include their home, their real estate, the business, investments, and so on. Then they have their retirement assets, designed specifically to provide retirement income, which can be, of course, pensions, qualified plans, IRAs, annuities, and so on. And then you have other tools out there that are available, which are tax-preferred assets, which would be a Roth or life insurance, cash value. So, consider these as your tools as you're moving forward and looking at this strategy. And each of these tools can effectively raise or lower the average tax rate depending on how they're used when you're helping your clients. So in the accumulation years, this is a major phase for clients' lives. They typically wish to improve their lifestyle, and they're also looking to help protect their family and assets, and they're trying to accumulate assets for retirement. So they're going to have capital assets, including the purchasing of a home, funding education, maybe starting a business, and investing in stocks and bonds and other types of investments that they might want to add to their portfolio. They're also going to be accumulating retirement income assets, typically 401ks being a very popular asset that they're going to be looking at, but also IRAs and annuities to a lesser extent at this stage. And then they also have the opportunity to purchase and fund Roth or life insurance to help with the overall plan. So, what a lot of people look at is, they're seeking to try to find the ultimate accumulation tool. Is it out there? What we want to do is find a tool that can reduce your income taxes today with tax-deductible contributions, provide greater growth potential by deferring taxes, and then having tax-free opportunity down the line, tax-free withdrawals. Well, the problem with that, of course, is that the ultimate accumulation tool simply doesn't exist. As you can see by looking at this, no matter which tool you use, whether it's capital assets, retirement income assets, or tax-preferred assets, they're all missing in one of these areas. There is no perfect tool out there. So you look at using life insurance as more than just a death benefit. You may not have considered life insurance as a financial tool. Your clients may not have, but in many ways, it is more than just a death benefit. Life insurance can provide an instant asset that will help them keep their dreams and aspirations going. How life insurance work? Well, of course, we all know the primary purpose of life insurance is to provide a death benefit. Some policies also offer cash value accumulation. Permanent cash value life insurance differs from other capital assets and retirement income assets in three main attributes. That would be death benefit, premium payments, and cash value. Let's take a look at each of these. Death benefit, the purpose, of course, the primary purpose for life insurance. It's there to help protect the family about lost income. If something would happen to the insured, helps them pay off debt. And of course, it also avoids probate. And that one of the nice things about death benefit on a life insurance policy is the family will typically have the cash in hand within 8 to 10 business days. Most insurance companies, once they receive the paperwork necessary and a copy of the death certificate, will actually cut that check and get it out in the hands. It's not going to be tied up at the attorney's office. It's not going to be tied up in probate. The money is going to be distributed directly to the family when they need it. So it definitely helps in that aspect. By making premium payments, of course, they're paying for the death benefit, and the charges for the mortality and other expenses of providing a death benefit, essentially covering the cost of term, if you will, comes off of the premium. The remaining amount builds cash value on a tax-deferred basis. Also comes out on a tax-preferred basis. So the third attribute is the cash value. Using that as a financial tool, a well-funded permanent life insurance policy offers tax-deferred cash value growth, tax-preferred distributions with no age restrictions at all. So what we do see here with Minnesota Life being known in the industry for having some very well-designed, very efficiently designed accumulation policies. One of the top in the industry. We're fortunate to be in that niche marketplace. We see a lot of, one example is sports figures. A lot of people who are making a ton of money in their 20s will max fund a life policy with Minnesota Life with the idea that when that income stops down the line, they will be able to access that, start pulling tax-free distributions out of the life insurance policy. 15, 20 years down the line, they might only be in their mid-40s. Well, they wouldn't be able to do that with other types of investments. So it does work out well. So then we get into the retirement years. In retirement, clients will typically want to sustain their current lifestyle and continue to protect their family, and also start to use accumulated assets to help fund their retirement so that they can have a nice, comfortable retirement. So basically, what can the clients do to fund their retirement? Well, of course, they have capital assets out there. They could sell their home. Maybe they've got a $400,000 or $500,000 house that's paid for. They could always sell that and move into something of lesser value and use that money. They could sell their business. They could liquidate assets. They will also start taking distributions from retirement assets, pensions, 401ks, and so on. And they also would have the option, if they funded tax-preferred assets like Roth or life insurance policies, to be able to take out tax-free withdrawals out of those. So what we look at here, and what we're going to talk a little bit about, is how you can use these lift materials to explain to your clients how they can close the gap on income. Will your clients have enough money to live on as they would like to? There'll be an income gap typically. And the income gap is, what do they have coming in from their required minimum distributions and their pensions and their Social Security, and what their actual income or their lifestyle expenses are. Typically there's a gap there, and they're going to have to fill that gap one way or the other. And the one way, of course, they could do it is by taking out bigger distributions from their qualified retirement plans. And of course, they're going to pay higher taxes by doing that. Or they can also look at filling that with tax-preferred investments. So they're seeking the ultimate retirement tool. Again, tax-deductible contributions, tax-deferred accumulation, and tax-free distributions. That would be the ultimate tool. And again, the ultimate tool doesn't exist. As you can see, all of these different toolboxes that you have here, the capital assets, the retirement income assets, and tax-preferred assets, they all are missing in one area. But they can have other benefits to them that can complement each other, I guess, if you will. So what we look at is, let's create a tax-favorable retirement distribution by creating a tax-diversified asset mix and using tax-preferred tools. They can have the ability to design a tax-favorable distribution strategy during their retirement years. The biggest way that they're looking at doing this is to have preferable tax treatment on assets in order to lower their average tax rate. So rather than taking distributions from a 401k or an IRA to fill the retirement gap, they can look at taking money out of a Roth or life insurance for that purpose. And so what I'm going to do is show you an example of exactly what we are talking about. So here is the tax brackets. So how will your clients fill their retirement income gap effectively and lower or increase their tax rates? So what you're looking at here is the marginal tax rate, and the effective tax rate. Now, this is actually a page right out of the lift materials that you can use with your clients, and so it shows them how you have a married couple. They're taking, let's say that they are, well, there's an actual example here, but you can see how based on the income that they want to pull out, here's what they would be taxed if it was all taxable. So the opportunity there is to try to see if you can save them some money. So let's take a look at a case study here. Here's an example demonstrating how the lift approach can help clients potentially lower their taxes in retirement. So you have one couple that has all of their money in qualified money, taxable distributions. And I used to run into this a lot, being here in Minnesota. We've got a company called 3M over here that there's a lot of employees that have maxed out their 401ks, and they come to retirement and they have a million and a half dollars in their 401k, and they have nothing else. They have $1 million plus in their 401k, and maybe their house is paid off, and that's it. So down the line in their retirement, if they need a new car, they're going to have to pull money out of, if they want to pay cash for it or even make payments on that car, they're going to have to pull more money out of their qualified to be able to do it, which of course is going to be taxed. The other couple that we're going to be looking at here is using Lyft, using a tax-sensitive distribution strategy. So let's take a look at the first couple. Again, these are stuck in their tax bracket because they have all of their eggs in one basket, so to speak. Their desired income is $100,000 a year. The required income that they have, which would be a pension, money coming out of maybe RMDs coming out. So they're looking at a $75,000 income stream that they have coming in between Social Security and pensions and so on. So their gap in this particular instance, in order to live the lifestyle that they want to live, is $24,700. So they'll have to pull that money out of their capital assets to be able to take care of that. So to achieve the desired income, they have, again, the required income and then the income gap. So in this particular example, this couple will pay taxes on the first two tax brackets and then 25% on the last. So their total taxes due in order to have a $100,000 income is going to be $16,392 with an effective tax rate of 16.4%. And you can see these are current numbers. These are 2016 numbers. So they're going to have to pay 10% on the first 18.5. They're going to have to pay 15% on the next 56,000 for a effective tax rate when you average these out at 13.8. And then in order to have the extra income that they want, they're going to have to pay 25% or another 61.75 effective tax rate on their retirement income of 16.5%. Now, let's take a look at the taxpayer with a tax-sensitive distribution strategy, one that used Lyft, worked with you and used Lyft as part of their program and saw that by max funding a life insurance policy, they were able to have tax-deferred growth and they can take money out tax-free. So let's take a look at this. Again, you have the same desired income of $100,000, the same required income coming in from RMD, Social Security pensions. You have the income gap, same exact numbers. So here's what this would look like to this particular couple. This couple will pay taxes on the first two tax brackets only. Their total taxes due will be $10,367.50 with an effective tax rate of only 10.4%. So they're saving $6,000 a year. Well, over a 20-year retirement with gains that they would have by leaving that money invested, you're looking at having an additional $150,000 or plus or more that they would be able to leave as a legacy rather than paying Uncle Sam for the same income stream. So the kids are going to get it, or in today's medical world, people are living longer as well. And so what you end up having is that money will be there to help sustain them for many more years, or they can decide to continue to max fund all the other options that they have out there and pay that money to the government instead, and not have the money there for themselves to use or their children. So this is a great way to not only, like I say, make sure that their retirement lasts longer, but also leaving a bigger legacy for their family. And you can see the results here as we look at this. We have so you see the end result. The second couple, again, the savings of $6,000 and a decrease in the tax rate of 6% compared to the other couple. So again, it's a great strategy, and the LIFT program that we have has a lot of materials that are available. There's an advisor training piece that's available that can be sent out that you can use for your review. There's also client-approved materials, including brochures, flyers, and there's actually seminar invites. And the presentation that I've shared with you this morning is actually client-approved. And so the PowerPoint itself is something that you would be able to use if you wanted to do a seminar on it and get some people in. So we have a lot of ways to help you show these clients the benefits of max funding a life insurance policy, letting that money grow tax deferred and be able to come out tax free later in life. So with that, that's really the presentation on LIFT. Kind of give you an idea of what we have available, and if you would like to receive these materials, you certainly can contact the sales desk at Messer, and they can go ahead and make sure that they get out to you. With that, I'll turn it over to Mark and see if there's any questions out there, or if there's anything we can do to help anybody out that's been on the call.
Steve, thank you very much. Again, as always, a very informative and educational presentation for the agents. I know, guys and gals, if you're like myself, that was a lot of information. You certainly couldn't take notes fast enough. So hopefully you just kind of listened. This has been recorded. It'll be back up on the Messer website under our Messer U tab or file, probably within the next 48 hours. So you'll have it at your avail to kind of go back through again and listen to and watch a couple more times. Again, as Steve mentioned, it's going to be available to you, having your contract and appointment done through Messer for MinnesotaLife. So if you're not currently appointed with MinnesotaLife, again, I'm going to guide you towards the Messer website. Take the time to go over to the Agent Resources tab, find that contracting tool, open it up, and get your MinnesotaLife contract in order so that you'll be able to sell the product. I think also it's important to note that you're going to find a lot of very good products. Before the webinar, Steve and I talked about the comparison, what's going on today with the sale of the Index Universal Life products especially. MinnesotaLife has a wonderful background and history and professionalism of handling those products in the past as well as currently today. So it's just another enhancement of why you would want to get appointed with Minnesota and why you'd want to have them as part of your arsenal of carriers and products that you want to have available. Again, being a life product, make sure you have E&O insurance if you don't already and you're just coming to us new. Again, that's another benefit of being with Messer. You could be able to sign on again to those agent resources and find the most affordable E&O insurance available in the industry. E&O insurance that is insuring you as an individual. You're not being grouped. So your $1 million pool of money, should the cause arise, is your money. You haven't shared it with another group of individuals who may have exploited the situation, and there may be no money left in the pool. So be careful with the E&O insurances that you sign up for. Look for one that is totally sheltering you and your own umbrella. Again, with all the information that Steve presented, I think it's going to be necessary really for you to go back and look at it. One of the questions we have is, will there be access to this information? And again, Wanda, yes, it's going to be posted on our website. You'll have the entire presentation with the verbal background available from Steve. And also, we can always get you the PowerPoint just for you to use and add your own verbiage to it as you sit with your clients. Again, Steve, you've done such a thorough job that we don't have any additional questions. So I think, yeah.
Well, I appreciate that. I hope that's the case, but
well, and again, I think it is. I think once there was so much going on here that, I mean, I tried to take notes, I'll tell you honestly, and I couldn't. So again, I know the agents out there like myself are going to have to go back and just go through it a couple of times and then get the notes you need so you can make those valid comparisons. I think probably one of the things that we all know as agents is that there is a way to use life insurance as a retirement vehicle. We hear it all the time. I think, though, what Steve brought to your attention, and again, it's why I like working with Minnesota Life, you're going to go out there and you're going to meet clients, and they've already started their plan. They've started their accumulation years with real estate, and they're in the stock market. They probably have minimally a 401k plan going. So sometimes as agents, it's like, well, I want to sell them life insurance, but I want them to stop doing some of these other things. Absolutely not. What you want to do, again, and this presentation does for you, is to show them that, yes, they've started a good plan. Let's enhance the plan. Let's make it better. Let's save them some of the costs that they would have been exposed to, especially with that death benefit in the years to come, that could actually help cover the cost of taxes related to other retirement benefits that they've established for their family and loved ones. So again,
that's a very good point, Mark. And one of the things that I like to use in that particular, going down that same line, and it's worked very effective for me when I was in the field, is that you talk to clients. When I get the opportunity to do that, to this day, I still use this line, and that is, if you happen to be one of the 16% that pass away before retirement age, your family is going to get this tax-free death benefit paid out to them immediately. If you're part of the 84% that make it into retirement, and these are statistics here in America, 84% of people will live into their retirement age, then they can go ahead and switch the product over and use it to provide a tax-free income stream. So you're really covering two needs that they have. They're able to protect their family now, if God forbid they fall into that 16%. If they be part of that 84% that's out there that make it to retirement, they'll be able to turn on that income stream. And one other thing, that another sales idea, I guess, or story that has worked really, really well for me in the past, is that if you imagine you've got four people that are together that are 40 years old, and one of them starts the conversation by saying, I just opened up a life insurance policy and I'm paying $400 a month right now for it. The other four are going to look at each other, and they're going to look at them, and they're going to say, what, are you crazy? Haven't you seen the ads or heard the ads on the radio, how you can get $3 million worth of coverage for $20 a month through ABC company or something? Why in the world would you be paying $400 a month? But if you fast forward 25 years later, and those same four people are sitting around together, the one says, you know what, I just made my last payment to my life insurance policy, And now they're going to start sending me $3,500 a month tax-free for the rest of my life. The other three are going to look at each other and say, God, I wish I would have done that. So it's all in, you put it into context. They're gonna say, boy, when they're 65, everybody in that group's gonna say, I wish I would have done that. I would love somebody to be sending me $3,500 a month tax-free for the rest of my life. And then, all of a sudden the $400 a month investment doesn't sound like such a big deal when you're getting $3,500 back tax-free. So those are a couple of things that you might be able to use in your daily practice too, to try to drive the point home to people when they take a look at what you're presenting. And if they say, boy, that seems like it's an awful big investment. Well, it is an investment out of your pocket right now, but look at what's going to happen down the line.
Excellent. And yes, again, ladies and gentlemen, Steve couldn't be more on target with that. And I can only say it from personal experience as I talked to my associates today that didn't follow my guidance to put themselves in the same position with their life insurance as I have for my own retirement today. Thank you for that, Steve. And I'd also like to add, Wanda out there is letting you know that she thought this was a very good presentation.
Well, thank you. I appreciate that.
And then Paul has got two very good questions for us today. First one Paul asks is MinnesotaLife a mutual company?
Yes, we've been a mutual company for 136 years. And so we were Minnesota Mutual, and then we, moved into MinnesotaLife, and now we are branding ourselves. We're moving into a more of a national branding name, which is Securian, which you'll see us move into that over the next 2 or 3 years. So we're not changing our name for any other reason other than marketing. There are some companies who have had issues and problems, unfortunately, and they've changed their name because of it. But with our company, we are just doing it really for marketing purposes, because somebody out in California, MinnesotaLife, who's that? So it's one of these things that as far as branding goes. But yes, we are a mutual company.
Excellent. And then Paul also has the background to ask this most important question as well, Stephen. Are you a whole life participating dividend company?
We are, yes.
And
but I'll be honest with you. I mean, our whole life contracts are kind of middle of the road. There is talk about redesigning and trying to come out with, but we have our products that are whole life contracts. We have an accumulating contract, and we have a death benefit focus. So we have two different whole life contracts that are available. They're competitive, but they're probably in the middle of the pack in the industry at this point, and they've been on the market for 4 or 5 years or something like that. And so other companies have enhanced their whole life contracts and have done more to theirs over the last few years. So you'll find that we're going to be good, but we are not going to be number one or number two. On the other hand, our IUL contracts that we've had going out now for 10 years, 11 years are still industry leading, and no matter what statistic you look at, we're going to be either 1 or 3 in the industry as far as those contracts go. So that's kind of where we are at this point, is that our IULs are sort of leading our sales, and we also have a GIUL. So for the people who like the GULs, we have a GIUL, which is the same situation. It's a guaranteed universal, guaranteed index universal. It has that secondary guarantee. So regardless of what the performance is of the contract, if they pay those premiums, that death benefit's going to be guaranteed. But with our IUL, our GIUL, there's more potential for, in good performance, the client could have enhancements to that death benefit guarantee over time. So it's actually, I think, probably the next generation of death benefit guarantee that more companies will follow suit. But as of right now, it's a unique feature that we have that actually gives the client some upside potential to enhance that. So.
And that also brings up, when we talk about the benefits that way, could you also address a little bit the long-term care riders available on their products?
Yes, certainly. I can do that. The long-term care, we have one of the more flexible options out there. We have an indemnity long-term care rider, which means the clients don't have to pay for their care ahead of time and have us and submit invoices and have us reimburse them. It's also they have access to it for informal care, so they could actually stay in their home and pay their granddaughter to come over for a few hours a day and help them. That's fine with us. It doesn't. The care does not have to be provided by a licensed facility or a licensed individual. So that's one of the things that separates us apart from a lot of other carriers as well. And so basically what we have is you can buy the death benefit, and let's say you choose to go with a $200,000 death benefit. You have the choice at the time you purchase the policy of either selecting a 2% of that benefit per month or 4% of that benefit per month to be paid out for long-term care if they need it down the line. And so they're either going to get $4,000 or $8,000 a month. They'll have access to take that out. Those distributions come out, of course, tax-free. It gets paid directly to them to use to pay whoever and for whatever they need. They don't have to take all of it. They could take part of it if they wanted to. They could take $2,000 a month to pay their granddaughter, and then as their care needs increase and they need to go into a full-time facility, they can certainly increase the amount that they take. If they use the entire $200,000 worth of benefit up for long-term care, when they pass away, the family would still get a $20,000 residual death benefit as part of that rider. So they would receive 10% of the initial death benefit up to a maximum of $25,000 as a residual death benefit as part of that rider. So again, I think the thing that makes it so popular is that it's a win-win situation. No matter what happens, the family is going to get a lot more money back than they paid in premiums tax-free, whether it's a death benefit or a combination of long-term care and death benefit. No matter what happens, they're going to get more money back than what they paid in. And in a lot of cases, it's substantially more, especially if they are thinking ahead and do it when they're in their 50s. It can be 3 or 4 times more premium dollars than they ever paid in that they get paid, the family gets back. And the fact that it's indemnity rather than reimbursement, it's very, very flexible. So they don't have to, the family isn't having to pay things ahead of time and then be reimbursed and stuff like that. So it's growing in popularity, and our sales have been increasing dramatically here over the last couple of years. I think if you look at the industry as a whole, all the conferences that I've been at so far this year are talking about standalone long-term care sales being down anywhere from 30 to 40% over what they were in 2014. And the reason for that is because many, many people are attracted to these hybrid contracts that are a win-win rather than pay these premiums, and if you don't use them, that you don't get anything back for it. So people are flocking to not just our contract, but others as well, that because there's a lot of different contracts out there. So hopefully that answers your questions on that.
Excellent. Thank you very much for that added information, Steve. Before I forget, we do have a couple more questions, but I want to make sure, again, for those of you who have been patient and have stuck with us today, should you be able to bring us a application on a permanent product? Let's limit it to that because, again, we're looking at how we're going to use these to life insurance as a financial tool. Anything that would be any of the UL products or the whole life products, Messer Financial will pay an additional $100 on top of your regular commission for your first sale that you bring us within the next 30 days that we can process and have placed in the next 60 days. So again, that will only be for those of you who are registered, and we have those names obviously on this webinar this morning. Not any reason why other associates of yours shouldn't go out and sell it as well after they see the information, but you guys get to be the extra paid group because of the time you've given us. Let's go back. We got a couple more questions here, Steve. Back on Paul again is asking, can you tell him what the non-guaranteed rate has been on the whole life business the last couple of years, or maybe what it is currently and last year?
We're at about 4.5% is where we are right now.
Okay.
And so that's actually, what our rate has been. There is some things to look at when it comes to whole life, and we can open up the hood and look at it, I guess, a little bit. But the fact of the matter is, the thing to look at, of course, is net internal rate of return is the most important thing. And there's a lot of talk, a lot of companies that love to have their brochures out there that say that they've never declared a dividend less than 6% or whatever since 1950. Blah 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 blah. Well, we all know that we are in a very low interest rate environment right now. And the fact of the matter is, there's levers that insurance companies can pull on whole life contracts. And one of the things that they can do is they can raise the cost of insurance. And many of them have done that over the last 18 to 24 months because they've gotten to the point now where their reserves are earning less than they were. One of the nice things about life insurance is that short-term downward trends in interest rates don't really affect life insurance that much, because about 1/20th of the reserves will come out of a long-term investment every year and have to be reinvested. So you have a couple of down years, it's not a big deal, but over a long-term sustained downward trend, a bigger and bigger part of the reserves, and now we're up to close to 25% of most companies' reserves have all come out of long-term investments that they were earning 6 and 7% on, and they're being reinvested at 4 in today's world, 3.5 or 4. So it becomes a downward pressure on it. So many of them have had to increase the cost of insurance, but then they'll turn around and they'll still say, hey, you know what? We've declared that we've never had a dividend that we've declared less than 6% since 1950. Well, if you take money out of your client's right pocket and you put it back in their left pocket, they're no better off than they were. And that's essentially what they're taking. They're increasing the cost of insurance in order to then turn around and declare a higher dividend. So they're taking the client's money and giving it back to them. But their brochure still looks great because they can say they haven't declared a dividend less than 6% in whatever 60 years or whatever it is. So keep that in mind too. Look at net internal rate of return as being the most important thing, because that's what really helps the performance of the contract and helps your client out, is what are they actually going to net. It's not just some of these marketing things that go out there talking about these huge dividends, because quite honestly, how are they continuing to do it? Of course, they can have some success maybe on their mortality. Maybe they haven't had as many people pass away that can add up to 0.5% better return than what they might be able to get elsewhere. And the only other way that they can do it is by increasing profits. And how does a mutual company increase profits? They increase premiums. And that's, and then they give the premium back to the client. So basically so keep that in mind too. If you're looking at other companies that are advertising, really high dividend rates, it makes everybody feel good, but in actuality, the net internal rate of return isn't as high as what they're advertising.
Okay, again, thank you, Steve. And this was kind of a difficult question Wanda has brought up. When she's working with her clients, is there a maximum age that the program or the benefits we've talked about today can really be presented to to have the impact and the success?
That's a very good question. And the answer, of course, is yes. There's a couple of things to look at. Typically, based on, there are costs involved with life insurance, obviously, because you're paying for a death benefit. If the client invests $10,000 this year in mutual funds and they get hit by a bus, the family's going to get $10,000. If they put that money into life insurance, the family would probably get it, $500,000. So there is a cost there for the insurance that comes off of that. And so with that in mind, what we normally recommend is that the client look at holding on and holding on at least for about 13 years plus. If somebody is not going to need the money for 13 years or longer, the tax-deferred growth within a life insurance policy can be very competitive. And when you start looking at that compared to other investments, retail investments that you'd have to be paying taxes on and getting 1099'd on as you go along and so on, the life insurance can actually perform better and give you tax-free withdrawals later on. So, and then the other part of that is, of course, the age aspect. Once you start getting into your 60s, the cost of insurance that we discussed earlier becomes more expensive, obviously, because you're looking at an average life expectancy of 82, 84 years old, depending on what you look at. So actuarially, the company has to make sure that they're pricing what they're charging for the death benefit correctly. The older you get, the higher that is, and a higher percentage of the premium dollar that goes in to help cover the cost of insurance, so there's less money going into the cash value to grow. So what I would typically say is that this is a great strategy for people who are, I would say, definitely under 65, and the younger you go, the better it is. I mean, 2 years ago, I sold my, at that time, 24-year-old son a policy, paying $139 a month on it. And when he retires, based on a 6% average crediting rate, which is conservative on an index contract, when you look at historical averages of 8.5 or 9, he'll have about 42 grand a year he'll be able to pull out tax-free. So that's when you buy it at 24 and fund it till you're 65, it does extremely well. But if you buy it at 60, it would be a situation where some people will max fund a policy at 60 with the idea that they'll have it paid up by the time they're 75, and then if they need money in their early to mid 80s, if they live that long, they'll have some money in there that they can use. But they're also using it as an estate planning tool at that stage, where the death benefit's going to be there as part of the estate planning. So for the younger you go, the better it is as far as a Roth alternative or a retirement alternative to other investments.
Thank you very much, Stephen. And Wanda, just for your information, myself personally, when I'm in the field, ideally, I love to find somebody under 45. Because at 45, I've got that 20-year window to 65, or increasing in today's world higher, but a 20-year pay or a pay to 65 for somebody under 45, I'm telling you, you get so much bang for your buck, and there's a lot out there.
It's amazing. It's amazing what, and sometimes people will look at it and say, how can that be? And really all it is just showing somebody a ledger of tax-deferred compounded growth over a long period of time. There's no smoke and mirrors here. It's just, if they were to find an investment that they could earn 6 or 7% a year on it and have it grow tax-deferred for all those years, they would still they'd have the same bucket of money 20, 25 years out. But people don't think of that, and when they're looking at stuff a lot of times. And so when you can go out and show them an illustration and say, here's what you could have, it's the numbers can be amazing. It becomes quite a good way to leverage their funds.
Yes, yes it is. All right. Well, ladies and gentlemen, I don't see any other questions. And again, I look forward to you coming and visiting with us again next week as we'll go into another presentation. I look forward also to your attending our expo in September. And again, Steve will be there. Steve will be presenting one of the hottest ideas. If you haven't watched our webinar before or go back and visit it, again, Steve, you want to tell them the title of that?
Yeah, it's the $99 legacy, how you can set up $1 million tax-free legacy for only $99 a month. And we actually have, we're getting thousands of these policies in as people are going out and talking with their clients that have young children and young grandkids. It's a great strategy, and we're having, again, some fantastic success with it. And so I would encourage you to, go back and listen to that one, as well as, if attend the breakouts. I'm going to be doing it twice at the expo. I think once each day. So if you can't make the first one, hopefully you can make the second one. And it's a great way to generate some easy business. Because we're one of the few companies that actually issue juvenile policies at preferred non-tobacco. So it makes it a great strategy, and we're probably the best company to do that type of strategy with at this point because of our underwriting. So.
And so, Rhonda, what that might be is the benefit when you were concerned about the age that you might present to. If you're working with a client that's a little older and perhaps this presentation today isn't the answer, I would think that the other presentation we just alluded to is going to definitely be an answer because they're going to have those younger kids or grandkids. So keep that all in mind. All right, ladies and gentlemen, again, thank you all. Look forward to hearing from you in the days ahead and attending with us next week. And again, Steve, thank you very much for another informative, beneficial presentation on life insurance.
You bet. Thank you, everybody. Have a great day.